We're going to calculate the stock price for Procter & Gamble. First, we need the market cap, which is 289.8 billion. Then the market price, 117.03. Now, to calculate the stock price for a company, we're going to estimate the future free cash flows of the company, discount that number back to today's value, and then divide it by the number of shares outstanding. They have 2.5 billion shares outstanding. The way you figure out the shares outstanding is you take the market cap divided by the stock price. And then we're going to compare the calculated stock price to the actual stock price and see if it's a buy or a sell. And this is what we call the intrinsic value. And this is a typical way for an analyst to figure out the value of a company. So now let's find the actual free cash flows. We'll go to the financial section in Yahoo, go to cash flows, then free cash flow. Now we need the net income. That's on the income statement. That's the profit and loss. And we take 4 years of financial data. That's what we use for the model. And last is revenue. So always take a quick look at the numbers to see how they move, to make sure there's no big outliers that could really mess up the model. So you can see net income takes a big drop in 2019. Something to look into. Revenue is fairly consistent, so let's move on. Now we need to look at the capital structure of Procter & Gamble and figure out the discount rate we need to apply to the future cash flows. So the interest expense is $500 million. That's the interest they pay on their debt. And let's see how much debt they have. We'll go to the balance sheet, the liability section. And the current debt is $10 billion. And the long-term debt is $20 billion. So they only pay 1.69% interest on the debt, which is a pretty good number. And the debt only makes up 9% of the capital structure. So 20 billion and 9 billion might sound like a lot, but when compared to a $300 billion company, it's not. Interest payments on debt are tax deductible. So let's find their effective tax rate. Okay, income before tax is $6 billion. Income tax is $2 billion. So the effective tax rate is 35%. So the cost of the debt is only 1.11%. To find the cost of equity, we need the beta. It's really low beta, 0.42. It moves about half of what the market moves. So the market goes up $1, this goes up 50 cents. If the market goes down $1, this goes down 50 cents. Low beta is a good thing because it's less volatile. And we calculated the cost of equity at 5.55%, and we used a CAPM model for that. And equity, as you can see, has a higher return than debt. It's almost 5 times. Exactly 5 times. Because equity is riskier. It's in the event of default, debt holders are paid before equity holders. And if you combine the two numbers together, you get the WACC, the weighted average cost of capital. And that's what we're going to discount the future cash flows by. So we estimated the future free cash flows in the model up here, 4 years of estimation. Then we did a terminal value, which is all years after year 4. Then we discounted those numbers back to today, and the value of the company is $406 billion. And when you divide that by 2.5 billion shares, you get a stock price of 164 compared to the actual stock price of 117. So it's trading at a discount, so it's considered a buy according to the model. Let's look at historical, where it was trading. So it was always trading at a discount, it appears. So stocks can trade higher or lower than intrinsic value. The stock price is based on market demand. If more people want the stock, it goes up in price. If more people want to sell the stock, it goes down in price. Just like anything in our world, if there's something that a lot of people want to buy, like a home or a product of some sort, the price goes up. But if nobody wants to buy it, then the price keeps going down till you find a buyer. So everyone has their own opinion on the stock market and on the value of a stock. This is my model. It's my opinion. And thanks for watching.